Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's the Wednesday edition of Trader Talk in today's market, and I'm your host, Kevin Horner. I'm joining you from our Denver studios, running solo on the show with all of you today. Thanks for joining me. I am, however, pleased to be joined by my friend and fellow coach, Barb Armstrong, in the chat. Barb will get to comments and questions I'm unable to. I'm always going to keep an eye on things. In fact, today I think it might be pertinent to bring your requests to the table where I can. So if there are areas of the market that I can review with you, I'll be happy to do that, especially if I've not yet touched on them, areas that you want to get to. In these solo shows, I end up talking quite a bit, of course. So let's make sure that we're addressing some of the stuff you all want to see. I'll try to do that for you as best I can. All right, so make sure you're following Barb and me on X, Barb Armstrong CS and Kevin Horner CS, a good spot to find us when we're not hosting classes. Barb and I also can be found on LinkedIn as well, and you're welcome to track us there. Admittedly, I'm not as active on LinkedIn, but I'm going to work on that for you also. If you're following or utilizing LinkedIn, check us out there also. Okay, so let's get to our disclosures. We'll move into charts rather, talk about the CPI number this morning and what it might mean for the broad market and expectations on rates going forward. So first of all, bear in mind, everything we cover should be considered informational and educational only. We're not making recommendations, nor are we endorsing a specific approach to trading. What we do offer you, though, are concepts, strategies traders may choose to employ when considering technical analysis. Remember, though, technical analysis is just one of our decision-making puzzle pieces, not the entirety of it. And we discourage you from making decisions exclusively and only on what you get in the way of technical analysis. So think of that as a decision-making puzzle piece, as I like to say, but just not the entirety of said puzzle. Okay, and then as usual, we will follow our fairly standardized approach for you all. We'll work with the major indices, hitting up the S&P 500, the Russell 2000, the NASDAQ 100, the semis. Take a look around on some sector leadership today. Looks like we've got tech moving again, and plenty of stocks to get to. So with all of that, yeah, we'll hit CoreWeave for you, Sam. We'll look at that move. We're going to look at Nebius as well, I think. We're going to talk about a couple of those trades. Look at what's happening in the SPX here this morning. A little bit of a pop following that CPI number. In fact, why don't we just address the CPI real quickly? The headline number came in at up 0.1% on a month-over-month basis, up 3.5%, 3.4 rather, on a year-over-year basis for the month of June. Now, core is the story we're watching here. The headline CPI coming in at 3.4 is notable, but the energy shock is coming through in the way of CPI, and that's simply because of the move upward that we've had in oil since the last report. So now one positive that we could possibly take is that shelter could become a bit of a tailwind, which is interesting because we know that housing has been difficult, of course, but it might be helpful for us. So shelter makes up roughly 1/3 of the CPI, and a monthly increase of 0.1% means that one of the stickiest pieces of inflation problems and difficulties that we've been seeing is losing momentum a little bit. So if that's losing momentum, if we're not seeing the increase in costs continuing to the upside with a momentum move, well, then we anticipate that slows, and then slowing becomes eventually reverse, right? And then that becomes a potential tailwind rather than a headwind. So something to bear in mind. And one of the things that we'll also call out is how the market has reacted to this right away. In fact, while I've got the SPX up here, I'm going to bring in the CME Fed tool because I think the shift here in expectations is notable. So this morning, after this report, if we take a look, if I can get my cursor here, there we go. So we are now at a 64 nearly 64%, pardon me, likelihood of status quo for September. Why is that significant? Well, look at where we were just a week ago. We were at a 45% status quo. So now, taking into account today's CPI and recent jobs numbers, The belief perhaps is that we can maintain without a need to hike. And if that's the case, well, the market's going to react favorably to that. The market doesn't want hikes for rates. Market would prefer status quo to cuts, but not to suggest that we're expecting cuts in any way, but I think it's significant when you see how traders are positioning here. And that's really the reminder about the CME Fed tool. It's a third-party tool. It's not a Schwab tool, so we can't validate it. But remember that letter B is that this is how traders are utilizing all the information at their fingertips, how they are reacting, and where they are placing their money. This is not a guarantee in any way that this is how the rate story is going to play out for September. And if we go forward, it's not a guarantee that we see that this plays out the same way as we get all the way out to the end of the year. But taking a look at the December viewpoint here, again, we reside at 350 to 375 on the Fed funds rate. And right now, the expectation is for one hike between now and the end of the year. And that one hike at 45%, it was much higher recently, right? If we look at the 375 to 400 at 45%, still at, let's see here, 375 to 4. Okay, so on the longer end, as we go out to December, what we're seeing status quo more or less hanging in here. But look at what's changed. It's that the secondary hike, the idea that there could be as many as two hikes between now and the end of the year has really come down from nearly 30 basis points up down to 22.5%. So notable. The big shift is for September. I think what this is telling us is that we'll continue to do what we do. Kick that can another month down the road. Let's see how this looks when we get out to September for the July detail. All right. So there's going, and remember, of course, all of this is the reminder. The reminder needs to be that this is all looking back in time. And so what's happened in the way of inflationary pressures in the last month can still play a part in what we're seeing from interest rates. So, keep all of this in your head as you're thinking about the way the market's acting for us at this time. Let's get back to that S&P. Let's talk about the levels. And I think we're all pretty confident with the levels here. Oops, I made a little bit of a snafu. There we go. So we still have that bull flag built in, everybody. Good CPI today, and yet we've not busted to the upside. You can still see the angle here. Clearly what bulls are looking for is that move through that upper level at 77.80 to push us into the 7,800. And then we have that potential for what many are targeting is in the ballpark of 8,000. And I will give you a reminder as to why that 8,000 is playing in here. Let's go back to the chart here. Basically, let's just looking at the high here. Our peak in the rally was 76.20, and then a week later we made our low, and our low came in at 72.37. So it was about a 380 point height to this consolidation triangle. And of course, what we try to do is take, for a measured move calculation, we take the deepest point of that triangle or the widest point of that consolidation window. And that was basically that 7-day window here. That 7 days where we fell about 5%. That gave us the deepest pullback. And then we take that amount, 380 points approximately, and you add it to the breakout spot, or basically the prior high, now potential support. Well, the prior high was 76.20. You add that 380 plus to that, all of a sudden we're at 8,000. Okay, that's where that math comes from. Now, no guarantee we get there, but that's where these targets are coming from. So if we can clear the highs we have made here at 77.80 this week and last week, well, then we have a potential for a momentum-based move to the upside. Now, of course, let's throw a little cold water on this, right? What happens if we get good CPI today, market feels better today, and we still don't break out? That is a heads up, right? We've already moved to the upside, and it's going to be difficult, admittedly, to pop through immediately and carry this bull flag into another breakout. That we should note that. But if it does, clear this level, we have to be prepared for it. The other alternative is that we simply can't get through these areas of resistance, and then it does become resistant. Look at where we opened today. I mean, essentially, if I extended my line there, we opened at a lower high, didn't we? And now we've faded. Now it's early. We're talking 10 minutes, so let's not overdo it, but this is absolutely notable. We know the levels. And if we know the levels where things could change, right, then we know how we may want to position. So risk on above the downtrend line I just drew in, maybe less risk on, and perhaps a little bit of profit taking under the 7,700 ledge at around here, 76.95 ballpark. So we'll watch that over the coming couple of days, because any pullback here could be opportunity in the intermediate term. So let's keep an eye on that. Yeah, Carol, you're right. The VIX is hanging out at that low ledge. We've got down 2% today. We broke 15. I know some of you out there look at the VIX as that discussion of should we be looking for profit taking as the VIX kind of hangs out lower. And I understand that thought process. If you're that longer term investor trader who adds time to your window, well then, yeah, hanging out in this lower areas could certainly be a reason for traders to be a willing participant in the profit taking, right? Building some cash, let the market do what the market's going to do. But I've always thought that the VIX is a little bit more of a trade when it spikes type situation. What I mean by that is that these low-lying areas, as we saw just this week, I think it was Monday when I was chatting up with Scott Durfee on here, we were talking about how in this 2-year window, the VIX really, by and large, resides in this 14 to 15 area. It's the spikes that it gets that are the mean reverting detail. So we know that spikes in the VIX commonly don't last nearly as long as these instances of low volatility. And you can see it. There are instances where it's very quick, right? Right there, right next to it. And then you've got these trend moves when we finally move into deeper pullbacks in the market. And then we're riding that 20-period moving average. Well, that's not what we're doing. And the last few times, like I said, the last few here, where we've seen those spikes, they've just been short-lived. And so maybe the look at the VIX is more on hey, we'll pay more attention to it when things get squirrely in anticipation of some drawdown and mean reversion, more so than, hey, we're hanging out at 14, 15, and we should be looking for market peaks. That has been something that traders have taken advantage of, but I'm a little less exuberant about that idea, simply because we do very commonly reside in these low levels of volatility. Yeah, it is low, Sam, but it's not the lowest. I mean, let's just go back to here. This is December of 24. How about 13 and change? I mean, we've definitely, in some of the windows of our broader moves to the upside, we've seen the VIX languish and just not provide opportunity as we grind higher. If you're a trader, not terrible to get a little bit of volatility from the market here and there. Okay, so there's a look at the VIX. Let's talk about that equal weighted version of the SPX, the SPX EW, which continues to show that strength. And I think the takeaway when we talk about the move we get in CPI kind of settling a little bit, we have the broadening of the rally with the equal weight index continuing to grind to the upside, not carried exclusively by technology, of course, but carried by some of those other segments of the market. And that equal weight is telling us exactly that there's an underlying movement of funds, that the health of this rally is not dependent on exclusively technology. In fact, when technology underwent its biggest pullback, as we've seen over the better part of the last 2 months, equal weight continues to the upside thanks to industrials, thanks to financials, thanks to healthcare. This is an energy now, right? So we've had a broadening. That is not a negative for the market, and it can be constructive to what we get going forward. So today's CPI kind of reinforces that argument that the leadership expansion can continue in the S&P 500 rather than simply being dragged upward from technology's rallies. So that's not a terrible approach, is it? I mean, that means that there are pockets, many pockets of successful trends within the S&P 500 at this time. Okay, let's talk about that NDX, the NASDAQ 100 up almost 1%. Let's go ahead and clean up some of these. So yesterday I was talking about the potential to visit the 20-day down here. We are right back to the peaks that we just created. So that high is, again, right in a zone we want to clear here, right? We are pleased by the action of the last 6 days if we're bullish, because as you can see, we've just held the breakout, right? We haven't gone down. We've maintained the 50-day moving average. We've maintained the downtrend line, former resistance, now potential support. We do have to admit we could revisit the 20-day if we, the longer we stay in this zone, the greater chance of testing the 20-day. But many a trader will point out that the 20-day is flattening. And what follows a flattening, if the flattening continues, is the rise, right? So we are on, let's see here, 1, 2, 3, 4, 5, 6, 7 days over the downtrend line. So that means we go another 7 days, and then we're looking at about 2/3 of that 20-day moving average being above the 20-day. So you can expect to witness the 20-day speedily moving higher if prices hold the elevated level we've seen over the last week and a half. So that means that the 20-day could be short-term crossing the 50 to the upside. Many of you like that from a trend standpoint. If you're that 20-day trader, you know how good that 20-day can be in the NASDAQ. I mean, we saw it here, right? We know that it rallied from strongly from April 8 all the way to June 3. So we had almost a 2-month full rally. It was 7 weeks, as it were, running the 20-day moving average. That was common, something we can get from the broad market here and from the NASDAQ 100. It's exactly what we got. And let's more or less, if you're a bullish trader, it's probably what we're looking for right now, right? Can we get the NASDAQ back in gear? The other thing is the reminder, these moves don't happen in my time frame, nor yours, unfortunately. So when we pull this back and look at it on a weekly, I gotta say, when you add or remove data points and you're looking at things a little more long range, things start to look slightly different and maybe even more encouraging as these moves, these pullbacks to the 50-week moving average have been opportunity. But this one is pulling back to the 20-week. We had a massive tail that came in 2 weeks ago. So we had bulls step in at 27,100, that is, and rallied it strongly enough to maintain the 20-week moving average. And then last week's move was so strong, big, beautiful candle, we easily cleared the high of our low week. And so a lot of traders would have been encouraged by what they've seen there. This is the same downtrend line I drew in on the daily. So by virtue of this huge candle, do we only have to go higher? No, we of course could witness some short-term weakness. This is where the 20-week moving average could be still supportive for us. So we have to at least be aware. 28,540 is the 20-week. 28,540. Let me just put in an approximation line. Oh, it's going to be right about here. Yeah, right in there. Okay, so look at where that goes. Let's just extend that backwards in time. Oh, you mean horizontal support? Yeah, that could easily be a spot for any weakness to find that foothold. But remember, that's also kind of an area to be very attentive to if we visit it, because moves under that ledge are going to look ugly on that weekly chart. Okay, so we're going to keep watching that as well. Private 8536, how does one take profit, manage taxes at the same time if working in a non-retirement? It's a difficult question. Unfortunately, it's not something we typically address in a class like this one, largely because we do not employ tax advisors, so we are limited in scope as to what we can speak to there. My encouragement would certainly be to consult a tax advisor. So do that. And further, I'll just say, as it relates to taxes, if you're a trader, you want to pay taxes because that means you're profitable. Unfortunately, we can hate on taxes all we want, but the truth of the matter is, if we're profitable, we're going to pay taxes, unless something dramatic changes with the current administration. There has been some floated comments about the potential to maybe shift capital gains taxes, but we're not going to address that until there's anything concrete. Okay. Let's see. In a stock chart for gap fills, if it fills halfway, is it considered to be a good enough for a gap fill or not? This is a good question, Nathan. I believe, and I think that the NASDAQ does a pretty good job of explaining it for us. We have a significant gap. I'm going to pull this off real quickly. So the gap is important for what it tells us about the shift in narrative often, right? In the instance that we had here, where we just gapped upward through the downtrend line. So, not all these gaps are not all gaps are treated the same, of course. This one feels a bit like a momentum shift gap. And what I mean by that is we should be witness to maintaining this move to the upside, even if we don't break out, meaning we should hold the low of the gap. There's never a guarantee that we will. Sometimes those gaps come into play on days where we get broad market weakness, a day where there's some technology headline that leads the NASDAQ 100 to maybe open in the gap, open at the 20-day, but that leads to buyers to say, well, this is silly. We should be buying at the 20-day here. And then they step in and you get a tail that resembles something like this tail, right? Where I'm pointing all the way back into early June here, where we opened really low, but that tail tells us that buyers stepped in to support price at that level. Always going to find interested parties at these spots of support. So when we get bounces that occur at gap levels, then it validates that gap level for us as a significant area of support. Now, whether we visit it at the absolute gap spot, or we fall into the zone of gap and then bounce, or we get all the way down and fill that gap and then bounce, all of those things can be viewed the same in hindsight. So whether it holds, falls into it, gets to the top, or fills the gap entirely and then bounces, they're all the same if it bounces. If it doesn't bounce and the selling continues, well, then we know that we have greater aggressive likelihood to the downside, right? So if we slipped through the 20-day moving average there, that would be a significant development at that point, because we would have already taken out the highest point of the gap and the lowest point of the gap, and be below a 50-day and a 20-day moving average, at least in this instance. I'm hopeful that that is providing clarity rather than confusion, but I wanted to at least address the idea that these gaps carry weight, because they absolutely do. Another one that had a great gap like that, just as an example, everybody, go back to the financials here. Remember when we were talking about financials in the late spring, I should say. I guess it was April, right? Remember, we were talking about it back here. We had a huge move. The financials broke the downtrend, got above the 50-day, and then needed all of, let's see, from April 7 until June 4, 2 months to go sideways and consolidate. In fact, so much so, and this was such a significant development at the time, everybody, I tweeted about it. I talked about this just yesterday. I actually put a tweet out on June 3 when we were trading at support at the gap low following the move up. I said, look, this is an important spot. If we can't hold this level, now we risk drifting lower and moving into a shorter term downtrend. And instead, what we got were buyers stepping in, and then we got a hold the very next day, another week of higher lows, and then it was off to the races. And we've been running the 20-day moving average in financials since. So I hope that that is an illustration of what can occur when we're thinking about gaps. And I think the reminder should always be, yes, gaps are significant. No, not do all gaps fill. Okay. Hopefully that's helpful. Okay. What about our small caps, everybody? The Russell up 0.5%. Let's back this off. Put this back into a 1-day chart. The Russell continues to show that strength. We're looking for the potential move to the upside. Same thing. NDX, SPX, RUT, all bull flagging, all hanging out at the upper level of the cloth portion of the flag. And you'll notice that I have applied the flagpole to the breakout. That is a potential RUT target if we can get there. Obviously, no guarantee we can get there, but that level could be as high as 3160 for a measured move if it can, in fact, break out, given what we've seen. And again, while yields have been persistently elevated, the Russell just continues to chew those moves to the upside. So digests it, takes it, and says, thank you. We still think the Russell has legs and less concern relative to yields, which again is not me getting what I think is happening, should be happening from the market. I'm only watching the trend here because my anticipation would have been that the Russell would be under pressure, and that's not what's happening. So again, we fall back into our basic approach as it relates to technical analysis, trading what we see, not what we think. And that is tough to do as traders sometimes, but nonetheless, I continue to remind viewers of this because I think it's so important when we're thinking about the market. Yeah, we can have our own narratives. We can buy into them. But what's happening on the screen, if you're a technician, if you believe in technical analysis, well, then you believe that the market knows everything that you do and then more, right? There is no knowledge of what the market should be doing that the market does not know. So it is aware of all. It knows all those risks that you're fearful of. It knows all the positives that you decide not to deny at this point, right? Maybe you're not as confident or as comfortable, but the market keeps giving us bullish moves, and we should at least respect that. Now, we know that that's not going to last in perpetuity. That's not the way the market works. So that's where our management processes come so important to us. All right, how about a look at our semis? Oops, that's transports. There's the semis. Rallied into the 50-day. We are still not confident necessarily. Improving chart, a lot like the NDX here. We've got that broken downtrend. If you choose to draw the manual downtrend line right through here, that's fine. You can also, draw it a little higher, none of which really matters because the truth is we've still not made a new high, right? We need to see the SOX continue through to the 50-day. As it relates to what's going on right now, this is a broken short-term downtrend, but not necessarily a new uptrend, as we've made a matching high, not a higher high. So again, remember how many of you who are here frequently have heard me say, when we pull back, matching lows are fine. It's lower lows we don't want to see. Well, by the same token, invert that thought. Higher highs we want. Matching highs, less excitable, right? Clearly, we need to get back up above the 50-day moving average. Some of you want to see that occur and maintain for 2 days, 3 days, maybe that so-called Horner rule with 3 closes in a row over a major area of resistance. In this case, that'd be the possibly the 50-day moving average. We've been basically below it since July 13. So here we are on the 12th of August, 4 weeks essentially below the 50-day moving average. Now, we try not to speculate what's coming next. Remember, this doesn't tell us what is the next move for the semis. But as a trader, If we're back up above the 50-day, well, then the trader's going to be much more confident and they're going to say things like, well, now the path of least resistance is higher rather than lower, and I can be a little bit more willing to put risk on the table, and it allows the trader to manage that risk better. Right now, if you're a buyer, we might still be stuck under the 50-day moving average for an extended period. It's exactly why a trader is often patient and allows time to pass, allows price action to rule, get back up above that 50-day. Well, then now you have a new way to manage your risk. In the near term, if you're putting trades on right here and we get rejected, well, that's going to hurt quite a bit, right? If you're a buyer at resistance and resistance holds, that's when our losses begin to get greater than with which we have comfort commonly. So please keep that in mind as well. All right, let us see here. Let's see what let's go jump back here to our visualize. Where are we moving around in the S&P today? So we're seeing tech with the green, Alphabet a little in the red, Microsoft, Apple, some of our biggest players in the red. We are seeing industrials kind of moving okay, but yeah, you're getting some breathing finally there in some of the financials and in healthcare, which have been giving us some leadership. Let's quickly peek on some of the bigger moves here. We've got energy kind of flattening out as it hit resistance just yesterday. So an important level for energy to get above. Broke that bull flag here to the upside and now at an area where it may be pausing. Let's keep on seeing here. So we've got materials breathing a minute. You've got the industrials holding that breakout in an elevated zone. The fact that it's not dropping but holding there, that's a positive for a lot of traders here from a trend standpoint. There's your discretionary. There's another gap zone, everybody. So you've got a gap level, and we're basically holding here. So that is worth watching for the immediate future because any slippage, you could be filling that gap, or the trader could say, yeah, that might hold up at the high of the gap, but it also could find itself back at the confluence of those major moving averages right here, couldn't it? Could easily be right back into this zone. So monitoring for that. The reminder I'll offer as it relates to the discretionary. This is not a true trending group, as you can see. It's more or less kind of sideways. It's been volatile up and down, but we're looking for easy management techniques. Unfortunately, the discretionary chart is not one of them right now. Same thing for staples, more in consolidation. Holding the 200-day moving average seems notable, but ultimately, I mean, I can draw this in, couldn't I? Something like that. Yeah, it's a fairly wide consolidation channel. Looks also like the exact same thing here, where we've broken to the upside, tested those areas of former support. So that all looks similar in staples. Here's a quick look at healthcare, which was lower this morning and is moving higher, but ultimately holding the 20. Actually, I think it's the 30-day moving average on healthcare that's most easily manageable. And I say that because while the 20-day has been violated, the 30 has not. So it's in healthcare, at least, if you go back to June 3, tests of the 30-day have been tested intraday and bounced. That could be a trend management area there for you all. So maybe something to monitor in healthcare with the 30-day rather than the 20-day. So 6 weeks rather than 4. Okay, let's see here. There's your financials, kind of pausing after the rally, the 20-day holding value there as we talked. And here is our tech, kind of bull flagging, similar to what we've seen with the NASDAQ 100 and with the semis. And then let's go ahead and hit communications, fading here. So you've got lower highs and lower lows and a new channel potentially. So this one bears watching, but remember, this one is largely led by the biggest of players, right? Your two sides of Alphabet, your come back here. Here we go. And your Meta, of course, and then you've got your standard communications companies, your Verizons, your AT&Ts, Comcast, etc. But Alphabet being the biggest is absolutely going to be driving a lot of communication space. And then what we've seen from utilities, recent double bottom here just this last week. That seems somewhat interesting. I will call out that the RSI is not necessarily giving us a signal because those are matching lows, not really. We would be looking for like a bullish divergence down here to kind of give confidence to that low. That would be helpful. Yeah, we can hit biotech, everybody. Let me hit the real estate real quickly. Just to point out once more, if you're looking for trends, you don't have to go very far, right? You have 11 sectors. They are mostly, let me see, are we all still green on the year? Yep, we're all green year to date. So we're having a great move, but they're not all trending in the way that makes it available to traders. So keep that in mind. Asks for healthcare. So we looked at healthcare. Let's look at biotech. Okay, we did have a biotech breakout here, didn't we? Similar moves, big explosion, followed by a bit of a flag right here. Flag broke to the upside, came back to the 20-day real quick. Notice again, some basic technical 101 stuff, everybody. Okay, we had a channel. We broke the channel to the upside. Downtrend line was resistance until it became support. And what did we do? We broke resistance, rallied for a couple of days, came back. Actually, if we extended that line, we would have easily tested. We could see that we tested that level, right? And then moved off of it. Resistance became support. And then once tested as support, you had a gorgeous candle here, and then a follow through hold day right here, which may have been a day where some traders got going in biotech. It's a good looking chart. Biotech is not the only space within healthcare doing all right, though. Let's see, pharma. Let's see, PHM, I think. There it is. Pharma dabbling as well. Look at this. You've got a bit of a range in pharmaceuticals. And if I duplicated that line and carried it up to the peak, yeah, you've got about, yeah, what is that, 10.2 to 10.9, 10, yeah, about a 700 point range there for a possibility of a breakout, kind of using the 20-day right now, but the 20-day has been quite porous on this. The 50-day has actually been fairly clear. Support, 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 support. Fell through it. It's resistance. It's resistance. It's resist. We're above it. Now it's support again. So one easy way maybe to manage a pharma trade here, utilizing the 50-day at least until that changes. As always, what works with technicals doesn't work all the time. How about some of those individual stocks, everybody? Let's take a look. So I mentioned we had some movers and shakers this morning. I did have one company that I thought I should mention that was an interesting upgrade, and that was Intuitive Surgical. Oppenheimer was upgrading Intuitive Surgical to outperform from Perform. They put a target on this at $500 a share. Field checks suggest that workflow challenges for J&J's Ottava that limit long-term appeal. Excuse me. What I mean to say is that note is interesting. That I apologize, everybody. What is being stated here with Oppenheimer upgrading to a $500 target, the firm views U.S. competition as a non-factor for ISRG. Intuitive Surgical's per-click model provides tremendous flexibility in lower acuity ambulatory surgery center penetration, seeing a positive risk reward at these share levels. What does that mean when they say what they did there? I read that as, hey, we like Intuitive Surgical long term, and look at where Intuitive Surgical is relative to where it's been. Here was the peak in January of this year. To the bottom, the thing sold down 44%. Now, we aren't down 44% at the moment. If we go to where we are now, we're down about 32. But guys, this is a pretty clear spot for a potential break, isn't it? So you've had a down channel. We're above the 50-day moving average. If this can get any legs and break the downtrend, Remember what those older charts we looked at this morning look like. You break the downtrend and it takes a little bit of time, but the break of the downtrend is commonly the first opportunity for early participation in a new move. Hasn't happened just yet, but it is a significant spot. And then a last thing I'll call out as it relates to ISRG, look at the volume as it's rallied down here. So clearly there was some interested buyers at this area. And when those interested buyers exceed average volume, I like to use the 50-day moving average of volume there. We can put that up in the volume pane. Remember what that implies for us. If the buying is significantly greater than the 50-day moving average of volume, the likelihood is that that is volume coming from institutions, not from retail traders. We retailers just don't have the power to move positions like this and volume size like this. So let's hit up a couple of those movers and shakers this morning. We saw Nebius was up. Wow, what a great move here in Nebius, up 21% here from a technical basis, breaking through an area of what I hope is obvious resistance for everyone. Now, it has not closed today, obviously. So the fact that we're at this elevated level feels good, but it's too early to call it a legitimate breakout. However, look at the volume below. Look at that. Already at the 50-day moving average of volume. Got to take that as a positive in the short term. If you're bullish on Nebius, you're going to look at that volume, assuming this candle closes this way. This is a good start on Nebius. Now, I was looking to see if I had any other specifics on it. I do not, unfortunately. So wanted to make sure that we at least looked at it. The notes are probably in here. There we go. Yeah, they beat on a couple of major levels. I thought I saw, there it was. So the estimate was a loss of 62 cents. They lost 12 cents instead. So they beat by 50 cents. And then revenues came in at sales, 582 million, which is a beat by more than 10 million. So that's being taken very favorably with Nebius here, and probably moving into a number of other areas and individual equities within the market as well. I saw an interesting development with SpaceX. Let's see here. So SpaceX, been watching for the move to the IPO day high, kind of an interesting spot. The stock had recently recaptured its, got above the 20-day moving average, and you'll notice that that's a positive development, even though volume has waned in here. Let's see here. Adding arrows left and right all of a sudden, everybody. The headline that I had on SpaceX yesterday, poised to more than, according to Morgan Stanley, quote, as investors see more breadcrumbs on the Cursor/Grok story, we see potential for implied valuation discount on SpaceX's AI business to lift, driving potentially substantial appreciation of the stock, end quote. From their conversations, very few investors are bullish on SpaceX's AI business beyond the Neo cloud, which results in an upside skewed catalyst path at these levels, saying ultimately the read that I have is that they are of the belief that current traders, current investors relative to SpaceX are not taking into account the AI story for them. And that's the reason that Morgan Stanley is carrying an overweight rating on SpaceX and currently a $300 price target. Again, no target is any guarantee to be achieved, whether that's a measured move or an analyst note. We also have CoreWeave moving today. Let's take a look at CoreWeave, everybody. I know I saw some of you guys talking that. There's another 20%er. 18 bucks today. All right, now my eyes are struggling, but I think there's the candle for it right there, everyone. So a wonderful breakout move. I've got a lot of drawings on this. Let's go ahead and see if I can change that to, let's just clear it out. All right, so there's all our moving averages. The stock has been struggling, as you can see, and we've had a real long-range support zone developed. We can at least say that much. And now, choppy as it might be, we've got a stock that's broken the downtrend. So the trouble here is going to be possibly the gap level management becomes tricky for those of you who are maybe in from these lows. This could be as simple as managing it at the gap zone, right? So that looks like a potential breakaway gap right now. Let's see what comes. You need more than just a day. What we don't want to see is a reversion quickly under the gap level. What we would like to see is that the gap zone holds and then we just start building new trend from here. Can't way too early to tell, obviously. Now, Baird raised the price target on CoreWeave to 130 previously at 100, and maintains an outperform rating on the shares. Firm updated its Q2 model on and maintains bullish demand environment says and supports the growth of the company. Wells Fargo analysts raised the target on CoreWeave up to 160, previously at 155. They maintain overweight rating on the shares, and the firm notes margin story is coming into focus on CoreWeave, highlighting their Q2 margins landing in the 30 to 35% range. Price increases and a shift to shorter duration and higher monetization models. So those are positives on CoreWeave. And so we've seen some pretty significant bounces here today. That's good stuff. All right, everybody, we are at time. I want to thank you all for being here. I hope we covered a lot of stuff y'all were looking for today. I know we hit all of those individual sectors briefly, looked at a number of key stocks, and talked about the importance of the move in the SPX equal weighted index in addition to the SPX, but most notable this morning, that somewhat cooler CPI and the possibility of what that implies for us going forward on the rate story. So lots covered today. So thanks to all of you for joining and for being here. Big thanks to you, Barb. It's great to have you back this week. Follow us on X, follow us on LinkedIn. If this conversation was helpful for you at all, hit the thumbs up button for me down below. That'll help us out on the replay and in the archive. As always, more to come from us today, so keep it tuned right here to the channel. I look forward to catching up with you all again real soon.